welcome again. This is Robert Schein, Managing Director and Partner at Blanke, Schein Wealth Management. Thank you for joining us for our January 9th, Tuesday edition of our Market Insights and Observations. It's our first video in person for 2024. And today we're going to talk about three topics, as you know, if you've tuned in from previous. Three topics that we're going to discuss that markets are paying attention to, so you should be too. So let's get right to it, market moving events. This week we have, essentially it's all about the data, and it's going to happen on Thursday and Friday. We'll talk about the reports and essentially what's going to be moving markets. So markets are sort of chopping through midway through this week until they get to those economic data reports, and we'll talk about why those are so important. The sentiment of both the consumer and essentially basically the asset allocation of the managers. Where are they? Are they super greedy, or are they very tepid in terms of their allocation, where we are in the marketplace? And lastly, again, we're going to talk about the labor markets. But this Thursday, January 11th, we're going to see the CPI and the core CPI. Now, it's a consumer price index, and it's a basket of goods and basically services that the government looks towards an inflation reading. Now, the government likes the core CPI. Essentially, that's the you take out energy and some of the volatility of this report. But the bottom line is that they're going to be looking for a modest, slight gain, but the rate of change is changing, meaning we want to see year over year coming down as we look at sort of a 3, 6, and 12-month year over year change. That's what the Federal Reserve is going to be paying attention to. Markets are going to be paying attention to. All of Wall Street is going to be paying attention to. So it's going to be interesting how we're watching the 10-year Treasury right now is about a 4% as we film this today on a Tuesday. But things could change. Again, if the inflation reading is hot, meaning higher than expected, and sort of a surprise in the news, you're going to see the stock market or the equity market sell off, and then bond yields basically go back up higher. It could be for that moment in time. It could be for over the weekend. Who really knows how long this will play out? But again, if the inflationary data comes in a little bit lighter than expected, or as expected, then we can see, again, stocks rally, because that just means that the Federal Reserve could be on hold, and then ultimately, again, for 2024, start lowering interest rates. The question is the timing of which. That would just reaffirm and confirm what markets have been front-running basically the last 6 weeks of the equity market as well as the fixed income market. And then that's going to be reconfirmed, if you will, by the PPI, Producers Price Index. And essentially that's what the, let's say, Walmarts of the world buy on their wholesale side. And so you want to see what the consumer is paying at the end, which is on Thursday, and then Friday is going to be what the the front end, pretty good reading of sort of our costs coming down, and if so, that leads to earnings. Now, earnings on Friday are going to start off with the big banks, and that's going to continue the next week, and it's going to be essentially the fourth quarter of 2023 earnings reports, and big banks kick it off. Now, we're seeing this week, even though we've got important data coming out later this week, the financials are performing very well ahead of in anticipation of earnings. So we want to see a few things from the banks. One, what's the impulse or the pulse of the consumer? Ultimately, are they digging into their pockets? Is a lot of their savings coming down? Where does the consumer stand right now? What does credit card delinquencies look like? The big banks can give us an indication on that. Because keep in mind, the consumer is 2/3 of the U.S. economy, and that supports earnings. And earnings, again, for the S&P 500 for 2024 are projected to be just around 9 to 10% increase for this year. So the question is, earnings estimates always get revised down. And very rarely do they get revised up. But a 10% earnings growth right now, which is forecasted by the markets right now for S&P 500, is pretty interesting. So the consumer is going to be keen to that and keeping that up and running. The question is, what's the sentiment look like? Well, ultimately, the Fed pivots on the U.S. consumer. Right now, the impacts for the U.S. consumer, if the Fed pivots, is going to be positive. But let's see this right here. The 12-month expectation change of interest rates going down. So expectations of interest rates basically coming down are rising, obviously, last 6 weeks more than ever. We just discussed this. And this is an inverse relationship of that. What's interesting about this is if you take a look at back in all these gray bars, these are in the previous periods of time going back to 1978. Those the gray bars are indicative. There's one for COVID, but that was like a month, so we really don't count that. Those are indicative of contraction in the economy, i.e. recessions. Now, what you see here, obviously, is that spike, okay? It's the spike that we're seeing in what we have, the interest rates expectations of going down. We're seeing that right now. So the question is, do we get a recession here for later this year? That remains to be seen. But those are sort of how history has played this out. And ultimately, we have the first leg to drop, which is the expectations that the Federal Reserve has pivoted and they're going to be lowering rates. Again, we has to be reconfirmed and affirmed on Friday and Thursday of this week. So that's why it's so important. Now, on the other side of that, how are asset managers positioned? Are they long? Are they short? What ultimately is the sentiment, again, of ultimately where we are in the market cycle? I said this a few weeks back when I was doing the media tour in New York, where I think we would see the Santa Claus rally continue through to basically year end, and then we have sort of an exhaustion, a sell-off, and consolidation, if you will. And that's what we're seeing right now for the first 2 trading weeks, simply because the greed factor here, any reading above this line here, is just showing that asset managers are basically over their skis or over positioned, extremely bullish right now. And that's not surprising because ultimately, if we look back, again, the last 6 weeks, the Fed pivoted immediately. They changed their language, and it was all bets in bull market in just about every asset class, from stocks to bonds, alternatives, even gold got a rally there as well. So ultimately, is also what the GDP now is predicting from the Atlanta Fed GDP. And we watch this indicator very closely as well. What's interesting here and what's very important here is this gray is aggregate hours worked on a 3-month annualized. And what we're seeing appear in the data ultimately is that there's a break positively for the Federal Reserve, meaning that the economy is still growing as measured by the GDP, but the hours worked per employee are going down. What does that mean? How does that even work? There's just more efficiencies in the economy, more productivity in the economy. And if that plays out in this particular divergence, because we do have a divergence here, the GDP is on an upward slant. We have the aggregate hours worked down, ticking down a little bit. So as that divergence, that means more corporate profitability. So again, earnings could come in as expected in terms of a growth of maybe 9 to 10%. Another thing we're going to have to keep an eye on, but the Federal Reserve has done a great job on, is cutting job openings. Remember, it's the JOLTS report. And what we said is ultimately those that are employed and those that are openings, it was 2 jobs open for every 1 job, and basically looking. And now those are converging together and ultimately closing down, meaning companies are ultimately, we're looking for 2 employees. Now they might be just looking for 1. Or essentially, if there's a potential of a recession moving forward, they're going to basically push off maybe quarter to quarter their basically growth initiatives by way of adding to their head count, meaning they're going to take those job opening offers off of sort of the all of the job websites, which is what this is being monitored. And this is basically said that the trend is going in the friend of basically the direction where the Federal Reserve wants it to go. And that's all our slides today. So we're going to pay attention to, the top 3 things: the inflation data that's going to come out, obviously employment data, as well as earnings. And that's going to play out for the next couple of weeks. But Thursday, let's keep an eye on the CPI and the core CPI report. And that'll kick us off for how we're going to basically end the week. But thanks for watching. Again, Happy New Year, and it's great to be back with you guys. See you again next time. Take care.